This is the complete story of how SpaceX, NASA's primary launch contractor, and the company building humanity's path to Mars went from a company you literally could not buy stock in to the largest IPO in human history, and how a shadowy secondary market worth over $100 billion made some people filthy rich and left others holding worthless pieces of paper. For over 2 decades, SpaceX stock was the most exclusive ticket in investing. No ticker symbol, no brokerage app, no public market whatsoever. If you wanted a piece of the company building the future of space travel, you had to know someone, have deep pockets, and navigate a financial underworld that most retail investors didn't even know existed. That underworld is called the secondary market, and what happened inside it over the past few years is one of the wildest financial stories of our time. Start at the beginning. SpaceX was founded by Elon Musk in 2002, and for years it was a money pit, a glorious rocket launching money pit, but a money pit nonetheless. The company nearly went bankrupt in 2008, and I mean nearly, as in they had enough cash for one more launch attempt. If Falcon 1's fourth flight had failed, SpaceX was done, finished, liquidated. But it didn't fail. Right around that time, a man named Luke Nosek became the first venture capital investor to back SpaceX. Nosek was part of the infamous PayPal Mafia, that absurdly successful group of early PayPal employees and founders who went on to reshape Silicon Valley. Peter Thiel, another PayPal Mafia member, threw in $20 million of his own money just weeks before that successful Falcon 1 launch. That $20 million saved the company. Think about that. 20 million. SpaceX is now worth 1.75 trillion. For years after that, SpaceX raised money the old fashioned private company way through venture capital rounds. Founders Fund got in early, then came DFJ Growth, Valor Equity Partners, Google, and Fidelity. In January 2015, Google and Fidelity together invested $1 billion in a Series F round that valued SpaceX at about $10 billion, which sounds like a lot until you realize that valuation would multiply by 175 times over the next 11 years. And unlike Blue Origin or Rocket Lab, SpaceX stayed stubbornly, defiantly private through all of it. Here's where it gets interesting. As SpaceX's valuation climbed, so did the value of the equity held by employees and early investors. SpaceX was paying its engineers and rocket scientists partly in stock, specifically restricted stock units, RSUs, that vest over a 5 year period at 20% per year. Great on paper. But paper was all it was, because SpaceX was private and there was no stock exchange where you could sell your shares. You couldn't open your phone, tap sell, and cash out. So, what do you do if you're a SpaceX engineer who's been there 6 years, you've got a few $1 million invested equity on paper, and you want to buy a house? You need liquidity. And since SpaceX wasn't going public anytime soon, that liquidity had to come from somewhere else. That's where the secondary market comes in. The secondary market for private company shares is exactly what it sounds like, a marketplace where existing shareholders, employees, early investors, insiders sell their shares to new buyers. No IPO required, no stock exchange involved, just private contracts between willing parties. Platforms like Forge Global, NASDAQ Private Market, EquityZen, and a newer player called Hive emerged as hubs for these transactions. They match sellers who need cash with buyers who want exposure to hot private companies, and no private company was hotter than SpaceX. But this wasn't like buying Apple stock, not even close. First, you had to be an accredited investor, defined under SEC Regulation D, Rule 501, meaning you needed an annual income over $200,000 or $300,000 with a spouse, or a net worth exceeding $1 million excluding your primary residence. Only about 13% of U.S. households qualify. Second, the minimum investment amounts were staggering, anywhere from $100,000 to $500,000 per transaction, with SpaceX secondary trades routinely requiring $250,000 or more just to get in the door. And even if you had the money and the accreditation, SpaceX itself could block your purchase. The company enforced something called a right of first refusal, or ROFR. Basically, if an employee found a buyer for their shares, SpaceX could swoop in, match the offer, and buy those shares back instead, keeping tight control over who actually ended up on the cap table. SpaceX also ran its own liquidity program through tender offers, typically twice a year. In these events, the company would set a share price and allow eligible employees to sell a portion of their vested shares, usually only 10 to 25%. CFO Brett Johnson and COO Gwynne Shotwell, who has run SpaceX's day to day operations since 2008, managed these carefully choreographed windows together, and they were the primary way employees could actually cash out. The numbers on these tender offers tell an insane story of value creation. In May 2022, SpaceX ran a tender where employees could sell shares at $70 each. At the same time, the company's primary round, where SpaceX sold shares directly to raise capital, priced shares at $270. Authorized investors were getting shares from employees at a nearly 75% discount to what the company itself was charging. An incredible deal if you were an authorized buyer, not so great if you were the employee on the other side. And who were these authorized buyers? Internal documents revealed that only a handful of investors were approved. Andreessen Horowitz, known as A16Z, was authorized to buy nearly 4.3 million shares for almost $300 million. GigaFund, co-founded by the same Luke Nosek who made that first VC bet on SpaceX back in 2008, was allocated over 1.4 million shares at a cost of nearly $100 million. These weren't random hedge funds. These were insiders, members of the SpaceX orbit, vocal supporters of Musk, or firms with historically close ties to the company. Now watch the valuation rocket take off. In 2021, SpaceX crossed $100 billion. By 2023, it reached $180 billion. The June 2024 tender offer valued the company at $210 billion, with shares priced around $112. Just 6 months later, in December 2024, a second tender pegged the valuation at $350 billion, shares at $185, with up to $500 million in repurchases. By mid-2025, another tender valued SpaceX at $400 billion, shares around $212, as part of a billion-dollar deal. Then in December 2025, SpaceX reached an $800 billion valuation through an insider share sale at $421 per share, with the company conducting a stock repurchase program of up to $2.56 billion. On the secondary market, prices ran even wilder. Shares ranged from $112 to nearly $249 on platforms like Forge Global, depending on when you looked. After the December 2024 tender, secondary prices stabilized around $229. By April 2026, Hive was listing SpaceX stock at around $832 per share. What was driving all of this? One name: Starlink. Starlink, SpaceX's satellite internet constellation, went from beta testing with 10,000 users in 2021 to a million users in 2022, 2.3 million in 2023, 4.6 million in 2024, and over 9 million by the end of 2025. By March 2026, they hit 10.3 million subscribers across 155 countries. Powering all of it is SpaceX's Falcon 9, the world's most flown orbital rocket, which launches new Starlink satellites approximately every 3 days, while Starship, still in testing, promises to deploy next-generation Starlink V3 satellites at a scale Falcon 9 simply can't match. Starlink accounted for $11.4 billion of SpaceX's $18.7 billion in revenue in 2025, up 48% year over year, and generated $4.4 billion in operating profit. It was SpaceX's cash machine. But not everything was rosy. Average revenue per user was declining, falling from $99 per month in 2023 to $86 in early 2025 to $66 by early 2026. The reason was straightforward. Starlink was expanding aggressively into price-sensitive markets across Africa, Southeast Asia, and Latin America. More subscribers, less revenue per subscriber. The math was getting harder. Then came two massive moves. In February 2026, SpaceX merged with xAI, Musk's artificial intelligence company, creating a combined entity valued at $1.25 trillion. On paper, it looked transformative, but in reality, xAI had burned $9.5 billion in the first 3 quarters of 2025, while generating only $210 million in revenue. The AI segment recorded a $6.35 billion operating loss in 2025, single-handedly dragging SpaceX into the red. SpaceX reported $6.6 billion in adjusted EBITDA for 2025, but a $4.9 billion GAAP net loss. Then on April 1st, 2026, SpaceX confidentially filed for an IPO. 21 banks lined up for the offering, a 5-for-1 stock split executed on May 4th, and on June 12, 2026, SpaceX debuted on the NASDAQ under the ticker SPCX, raising $75 billion dollars at an implied valuation of $1.75 trillion. The largest IPO in history. Shares priced at $135 post-split, demand ran 3.5 to 4 times oversubscribed, with over $250 billion in investor interest. Goldman Sachs led the deal, and in a genuinely unusual move, 30% of the float was allocated to retail investors, 3 times the standard for mega cap IPOs. Here's where the story takes a dark turn. For years, as SpaceX's valuation climbed, an entire shadow economy grew up around access to its shares. Not just the legitimate platforms like Forge, Equity Zen, and Hive, but a murkier world of special purpose vehicles, SPVs, and sometimes outright scams. An SPV is a pooled investment vehicle, typically an LLC, formed specifically to buy SpaceX shares by aggregating money from multiple accredited investors. A lead investor negotiates access to shares on the secondary market, forms the SPV, buys the shares, and admits limited partners at minimum check sizes of $25,000 to $100,000. Sounds reasonable enough, but the problems were rampant. Hidden fees ate into returns, payout delays stretched months past major liquidity events, and the layered structure of SPVs made due diligence nearly impossible. Some SPVs were straight up fraudulent. Anduril co-founder Matt Grimm put it bluntly, saying some investors think that they have bought into SpaceX, but they're actually just funding some dude's coke habit in Miami. Samir Kaji, CEO of private markets platform Allocate, called out the fee structure specifically, saying, "That's still fraud because I think that you're misrepresenting to an investor what their economic outlook is." When SpaceX went public, the reckoning arrived. Shares that had been traded through private contracts and opaque SPVs needed to actually convert into real exchange-traded stock. And for some buyers, that moment of truth revealed their contracts were worthless. They didn't actually own anything. As one report described it, they wouldn't know if the paper contracts they bought were worth the paper they were written on until it came time to try to sell them. That $100 billion shadow market faced its reckoning on IPO day, and some shareholders discovered they owned nothing at all. Even legitimate holders faced headaches. Employees couldn't sell all their shares immediately because of lockup restrictions, standard post-IPO lockup periods that prevent insiders from flooding the market, and staged unlock schedules. RSUs settled and became taxable, and SpaceX withheld shares to cover taxes. The transition from private to public equity was messy, complicated, and expensive. Then there's the valuation question. At $135 per share and a $1.75 trillion market cap, SpaceX was trading at roughly 94 times its 2025 revenue. Morningstar analyst Nicholas Owens put the fair value at approximately $780 billion, roughly 55% below the IPO price, citing a tiny public float, the possibility that index inclusion mechanics were artificially inflating demand, and SpaceX's unproven profitability. On the other side, Cathie Wood's ARK Invest forecasted SpaceX could reach between 1.7 and 3.1 trillion by 2030, with a base case of 2.5 trillion. One more thing worth knowing, Elon Musk's control of SpaceX survived the IPO fully intact. The filing disclosed super voting Class B shares carrying 10 votes per share, giving Musk and insiders voting control even after going public. Musk is estimated to own 42% of the company. So while SpaceX is technically public now, it's Elon's ship, and he's still very much the captain. So what's the takeaway from all of this? The SpaceX secondary market was a financial frontier. It created enormous wealth for savvy early investors and well-connected insiders. GigaFund invested over $1 billion in SpaceX starting in 2017, and those returns are now astronomical. Andreessen Horowitz, Sequoia, Founders Fund, and the Ontario Teachers Pension Plan all profited massively. Employees who held their equity through years of illiquidity and sold at the right tender offers changed their lives. But for those who navigated the gray areas, who bought through unvetted SPVs, who didn't understand ROFR clauses, who couldn't distinguish legitimate secondary transactions from elaborate scams, the secondary market was a minefield, a $100 billion minefield. The SpaceX story is ultimately a story about access, who gets it, who doesn't, and what people are willing to risk to get a seat on the rocket. For 2 decades, the most transformative aerospace company on the planet was invisible to ordinary investors. The secondary market was supposed to democratize access, And in some ways it did, but in other ways it just created a new kind of inequality. One where the price of admission was high, the rules were opaque, and the risks were hidden behind layers of financial engineering. SpaceX is public now, and anyone with a brokerage account can buy the stock. But that wild era of secondary market trading, the tender offers, the SPVs, the shadow deals, that chapter deserves to be remembered because it reveals something fundamental about how wealth gets created and distributed in the age of private mega companies. The people closest to the rocket always get the best ride. Everyone else is just trying not to get burned by the exhaust.